Have you ever wondered how top business leaders or potential investors quickly grasp the health and potential of a company? It's not magic, it's a systematic approach. Financial ratios are incredibly important in business because they provide a standardized, quantitative way to evaluate a company's performance, health, and efficiency by comparing different line items from its financial statements. They transform raw financial data into meaningful insights, acting like a universal language for assessing business operations. The core mechanism behind their importance lies in their ability to contextualize numbers. A single number, like sales of $1 million, tells you little on its own. However, when you compare those sales to, for example, the cost of goods sold or total assets, the ratio reveals crucial relationships. These relationships allow for critical analysis across 5 key areas: liquidity, which is the ability to meet short-term obligations; solvency, which is the ability to meet long-term obligations; profitability, indicating how well a company generates earnings; efficiency, showing how effectively assets are utilized; and market prospects, which gauge investor sentiment and future growth potential. By dissecting these aspects, ratios provide a holistic view that raw numbers cannot. To effectively use financial ratios, begin by calculating them from a company's balance sheet, income statement, and cash flow statement. Then, compare these ratios to historical data for the same company to identify trends, compare them against industry averages to benchmark performance, and even against competitors to understand relative strengths and weaknesses. For instance, a declining profit margin might signal rising costs or competitive pricing pressures, prompting a deeper investigation. An insider tip is to always consider the qualitative factors alongside your ratio analysis. Ratios are quantitative snapshots, but understanding the company's business model, management quality, and the broader economic environment provides a more complete picture. For example, a high debt-to-equity ratio might be alarming, but if it is typical for a capital-intensive industry or indicates strategic growth investments, its interpretation changes significantly. This integrated perspective, often called fundamental analysis, truly distinguishes a superficial glance from deep insight. Ultimately, mastering financial ratios empowers you to move beyond just looking at numbers to truly understanding the stories they tell about a business. They are indispensable tools for making informed strategic decisions, identifying risks and opportunities, and communicating financial health with clarity and confidence, whether you are an analyst, a manager, or a potential investor. They equip you with the clarity needed to navigate the complex world of business finance effectively.